Welcome back to Trading Day. Your call 1300 30 34 35. Email us at yourcall@yourmoney.com.au if you'd like all of your market queries answered. You may have a question about what's happening with the market. Well, let's take a look at what's happening today. It is in fact a sea of red right now. ASX 200 there down by about 1% to 62.30 right now. In fact, it is the technology and the financial sectors that are taking the biggest hit. All the sectors are in red currently. Main Pharma taking the biggest cut today, down almost 15%, as it warns of sales of its generic drugs have fallen by a third. Also making news this hour, that trade war between China and the US ramping up even further. China has now confirmed that it will hit US imports with tit-for-tat tariffs. As a result, you can see there the yuan really suffering here, plunging as US tariffs start to weigh in on the global economy. Let's take a look at some of the top movers by percentage change on the 200. And it is the gold stocks that are doing the best. Of course, you can see their Evolution, Regis, Saracen, Northern Star, St. Barbara there. All the gold stocks doing really well. Of course, price of gold is up by about $3.37 to 1,303 right now. Everyone flocking to the safe haven. And as a result, we can see our gold stocks doing pretty well there. On the bottom rung of the ladder now, taking a look at what's happening down there, we've got Main Pharma and National Bank heading the group, of course. Main Pharma, earlier on, its shares were down by about 15%. You can see it's still down by about 15%. This was after it was reported that it had a 32% drop in revenue generated from its generic drugs. NAB shares, of course, down. It is trading ex-dividend. Now, you want to get your market queries in as soon as possible, and here to answer all of your queries, we've got Elio D'Amato from Lincoln Indicators. We also have David Novac from Wealthwise Education. We want to go to a viewer email now, and this one is from Linton. Linton asks, well, firstly, thank you to all the crew for a great show. Well, thank you, Linton. Could you please comment on Bravura for growth and Telstra as a beneficiary of the 5G network? There's a lot of talk about Telstra and 5G. In fact, that conversation never seems to end. Elliot, what to make of Telstra? We'll start with Telstra first.
Well, obviously, Linton's smarter than the average bear. We really like these two businesses. Both of them, Bravura Solutions, an innovative IT platform providing back-end solutions to a lot of wealth managers and the like, not only here in Australia, but overseas as well. It's one of our star growth stocks. It's done exceptionally well for our members, and we continue to remain believers in the business. So I haven't seen its share price today. I dare suggest it's probably been sold off a little bit on the back of the tech sell-off, for the use of a better term, but that'll just create great buying opportunity in this wonderful long-term story. With regards to Telstra, as I alluded to prior to the break, it was one of the stocks we were avoiding. It was a stock we removed at around $5.50 from our portfolio on concerns of a dividend cut. We've seen a few of those now come through. We've seen a rebase on the business, and we feel that relative to the active risks and the now still reasonable attractive dividend that's available to the company, it's worth considering from an income perspective. From a growth perspective, the 5G network is its next catalyst for growth, obviously. It definitely helps that the ACCC's come out and decided to play corporate advisor rather than regulator in knocking on the head the proposal between the Vodafone and TPG, although I do believe that that will be heading to the court, so I don't think that chapter is over just yet. But for as long as they can control that 5G network, that will obviously be a driver for earnings, because it will be all about mobile. It's not going to be about fixed line. Corporate's pretty much topped out for them, so really they need that to be a winner. For now, on balance, we think it's worth the risk from an income perspective.
You're right, there's a little bit of selling off of Telstra at the moment, down by about 0.5% to 343 today. I want to come back on your thoughts on Bravura in just a moment.
Yep, okay.
Your thoughts on Telstra, David?
Yeah, look, the same thing. I just think they obviously the main beneficiary after this ACCC decision with TPG and Vodafone. So they're obviously for income investors as well. But like I said, I still like to see their growth numbers here, but they certainly will come out on top of all this. And like I said, it's not over yet, but surprise decision by the ACCC. But look at where it is and Telstra is right now. It's technically speaking, it's getting some resistance up here. It needs to break high above that 345, 346 to go higher. And you don't want to see it go below 320. And Bravura just is on a tear. You know, this stock has been incredibly strong since the beginning of last year. So stick with the trend is what I say.
We're actually going to touch on TPG for the next email, but your thoughts on Bravura very quickly, Elliot.
Just to reiterate, it was one of our star growth stocks, incredibly strong business. Mr. Mitchell owns something like $100 million. He's the chairman of the firm, and that continues to remain a very strong, keen interest in the business. They did have a capital raise, as there was talk that they may be acquiring GBT, one of their competitors. You want to see their share price versus Bravura and see what the difference is between a great quality company and one that struggles.
Definitely. Okay. Thank you very much for writing in, Linton. We want to move on to Keith now. I mentioned we were going to touch on TPG, and this email from Keith actually is about TPG. Keith writes to say, I bought TPG shares at $5. They're currently $6.28. Should I, and these are the options that he's giving the panel. 1, sell and buy Telstra. 2, sell and buy in another sector. Or 3, hold and hope for a favourable federal court appeal. Of course, this appeal is going to be long and drawn out. It's going to take some time, of course. Elio, what do you make, though, of TPG?
Well, look,
time to get in on them now?
Well, look, it's interesting. I mean, they're financially healthy, which is good. And if there's anything that David Teo doesn't know about the telecommunications sector, then it's not worth knowing. So obviously, you're backing a pretty strong jockey there. The only issue I have with the question, and I mean this obviously as constructive feedback, and I'll be interested in David's thoughts in regards to this, but you know, if you're going to buy a stock, you sure already know what it's going to take for you to get out. Be it either you're in it for a short, a good time, not a long time, and you want to make a quick dollar. Either you believe in the long-term story and you then need to ask yourself, has anything changed in that story in the near term? And that third option there that you mentioned about the federal court case, well, if you bought it at $5, you actually didn't know that that was actually occurring at that stage. So really that shouldn't be a consideration for your exit trigger, because really you would have either bought them to make a quick short-term profit after initially the price declined, either after Huawei or even prior to that through their other previous trials and tribulations, or you do believe in the long-term vision and you think that management have a proven track record and therefore you're willing to ride this out. Like I said, I don't think that ACCC decision is going to be let go of easily, so I think there will be a bit more time to play out there in that regard, and they may actually come out on top at the end of that. But yeah, you have to go back to why you bought it, because why you bought it will tell you exactly the reason why you want to sell it.
Is that something that you share, David, in terms of, whether the court, wherever the court sort of falls, that really shouldn't fall into your decision as well? Yeah,
absolutely. But and also, getting back to the fundamentals, absolutely. But the technicals is the other thing. That when I looked at the technical or the chart, one of the things I've been teaching for the last 21 years, and I've learnt certainly through the School of Hard Knocks, is don't bet against the trend. It's like, boy, have I learnt that lesson. And that's what we teach investors is timing is critical, and when to get in, and very important when to get out. So TPG, I mean, when you look at the chart since the beginning of the year, it had a little bit of a bounce, but after that big sell-off from October to December, now you're looking at it coming back down, testing those lows. So the trend hasn't been positive since the beginning of the year. So that in itself was giving you a little bit of a warning, like, okay, is the deal going to go through or not? Plus just being a little bit cautious, just that alone with the market rallying, and TPG hasn't gone on with it. So for my money, I wouldn't be sitting there. I don't like sitting in stocks and hoping things are going to go up, or they're going to go back up, I should say. Hope is not something you want to be involved in the markets.
No. Couldn't agree more.
It's you might as well go down the church on Sundays and light a few candles. So I wouldn't be in it for that reason alone. Sure, you could put some of it into Telstra, definitely, or other stocks that have got better growth prospects.
Would you sell it at $6.28 now?
Well, technically, yeah, I'd say I wouldn't be holding it. It's not positively trending, and I don't want to be in a stock that's just, it's looking weak here. So it could there could be further downside here. And how long would you be holding this for? Could the federal court thing could take another year?
Absolutely.
You know?
Yeah.
So why sit there waiting and hoping it's praying that's going to go back, rather than being what they call a BHP investor, buy, hold and pray.
Yeah.
Light a few candles. Keith, thank you very much for writing in. Now, Andrew is on the line. Andrew is calling in from Sydney. Your question for the panel is about live tiles. Was there anything specific that you wanted to know about live tiles, Andrew?
Yeah, I purchased live tiles probably around 3 weeks ago now, and it has dropped around 22% currently. It's only dropped just over 1% today, which is surprising, which is a good day for it considering the performance it's had the last couple of weeks. Do you think with the trading wars going on at the moment, do you think it's a good time perhaps maybe to sell up and just wait till there's some stability back in the market before getting back in?
Okay. What do you make? Do you think that the trade wars actually play out, particularly in terms of live tiles?
Look, well, Live Tiles, for those that are not aware, is a US-based software development firm, and followed a recent trend of a few US tech companies which are seeking Australian capital. The company's financially unhealthy, though, so it's not a stock that we would take a position in. And if our members were investing in it, Andrew, they're obviously doing it from a speculative perspective, which means you're in it for a good time, not a long time, which questions then have to be asked. How did you leave your stop loss level so loose as to what it was? Because ultimately the pursuit of a short-term gain can become a long-term loss if left unchecked. Obviously, they're right in the thick of what's occurring there at the minute, though you would need to look at their client base as to whether they're going to be directly affected by this. I dare suggest it's probably a little bit more broad than that. So if the underlying reason as to why you bought the stock still remains in play, then there's nothing that immediately changes that in the near term. And in fact, if they're generating earnings in US dollars, then that should translate into Aussie dollars even better. But the problem, they're not making money just yet. And that's not intended to occur till next year, actually. So obviously updates from the company as to whether they're able to maintain that or achieve that will be what you'll be looking for. But it's a higher risk venture, which means your stop losses should have been in place in our view, and therefore you would make a decision based on that, to which until the fundamentals come in play and until it meets our quant metrics, we're not going to partake.
Okay, live tiles currently at about 41 cents. What do you make of live tiles?
Yeah, look, there's not much I like about it really. It's the fundamentals, all the technicals. Again, getting back to my previous comment, there was an exit here at 55 cents, which is the get out of the jail card there. So now it's come all the way down here. It's quite weak on the trend. There's been increased volume on the selling side. So look, I don't see much attraction at all to jump into this one, so I would leave it alone. And it hasn't got the revenues or the
No, not yet.
Not yet. So, you know, again, it's I'm not such a keen investor in profitless companies.
Couldn't agree more.
Okay. Thank you very much for your call. We want to move on to another caller now, and this is Vince, who's calling in from Melbourne. Your question for the panel, Vince.
Oh, hi, Fazia, Elio and David. I've got a couple of things I just wanted to talk about. First was Macquarie Bank. I noticed it's come back quite a bit from $130 odd. Is that good buying at the moment? Yeah, I'd like to get the panel's opinion on that. And the other thing too, I'd just like to thank you all very much for providing such a fantastic program. I've enjoyed it over the months, and you've provided great quality people such as Elio and David. And Howard Coleman and people like that. And it's pretty disappointing that you're actually finishing up. So
Yes.
Is there anywhere else we can go to see such great professionals?
I think you can catch David. Wealthwise
Education.
and
LinkedInindicators.com.au.
So there you go. So that's that. And Vince, thank you so much for
Yes, thank you very much for those kind
watching
words,
as well.
Vince. Thank
Without you, there wouldn't have been a show. So thank you so much for your support. Let's get to your question now. Macquarie, what do you make of Macquarie?
Well, much like, you know, the pride a master has when their apprentice actually makes their first chair, I think young Vince here has actually found himself a ripper. Look, Macquarie is a great business. I know a lot of investors, including our members, have been a little bit concerned by by the fact that its share price has come off in recent times. It's one of our borderline star growth and star income stocks, so we actually like it from both a growth and income perspective. And I think if there's any bank on the exchange that you actually want to own, this is the one. So if I could take what Scott mentioned a little bit earlier in the program, if you were willing to buy it yesterday, then would you buy it today? And Macquarie's definitely one of those you would do that. Look, they did come out with an update recently, which was a little bit disappointing, or the market perceived as disappointing. The company didn't flag any growth because they were cycling off what was a strong period in the prior period. But don't underestimate Macquarie. They're perennial under-promisers and over-performers. So we think they've got a rabbit to pull out of the hat there in that regard. With a grossed-up dividend yield of 5.8%, plus, you know, strong earnings growth expected. I mean, 15% over the coming year. Well, that's what consensus says. 15% expected over the year. You're not going to get that in any of the other big four. So if you were going to hold one, this is it, Vince. And yeah, be patient. It's just a bit of short-term fluctuations.
Macquarie at 118.34.
Yeah, look, I you know, you have to like Macquarie. Look, technically, there's a little bit of damage done here with the. I mean, it's gone ex-dividend, of course, the day before.
Yep.
But look, down here, yeah, it is an opportunity. I did think that the rally from those December lows of 105 up to 135 was
very quick,
very fast. So, you know, that was prudent to take some money off the table, I thought. Now, if you did take money off the tables, this would be a time to start jumping back in again. So, absolutely. I mean, this is the premier bank. It's the #1 investment bank in Australia. There's, you know, so smart boys in the room there. So, and they just seem to be, you know, keep doing the right thing. So, they've got, like Elio said, they've got a combination of that growth and income factor, which is very beneficial.
Indeed. Thank you very much for your call there. We want to move on to Greg now, who's calling in from the Central Coast. Your question for the panel, Greg.
Yeah, g'day. When you fundamentally analyse a company, what are the key elements that you look at that form the basis of your investment decision? Thank you.
That is a great question.
Oh, great question.
Such a good question. Thank you so much, Greg, for asking that question, for calling in. Do you want to? What do you actually look at fundamentally?
Oh, look, Greg, we don't have a whole show for it, but obviously the good news is it doesn't have to be as hard as what you might think. You need to start first and foremost by identifying what we like to call quality businesses, businesses that are just great companies. And the cornerstone to that is our financial health score. So we analyse 12 key accounting ratios in order to be able to identify the level of financial risk that a company is exposed to at any particular point in time. That involves things like looking at the debt, looking at its cash flow, in particular its operating cash flow, because we want to make sure that the company is, you know, generating strong earnings, not from profits, because profits are, you know, things that accountants do, but actually driving underlying earnings. That's really what we want to see. So once a company is financially healthy, exposed to acceptable levels of financial risk, then we delve a little bit deeper. We look at factors like return on equity, return on invested capital. What sort of return are they generating from the businesses, from the money that's been invested in them, or the money that they've invested in the business themselves. We look at net profit margins, because, you know, if you're making $1 billion, it's not really worth it if you generating revenues of $1 billion. If you're only making $10,000 worth of profit, you're better off selling the business and going and working a day job. You know, so you want to make sure that your margins here are incredibly strong. You want to grow your top line though. You know, you can only cut your bottom line so long before you suffer corporate anorexia. You've got to make sure your sales are growing, driving that growth, and then earnings per share growth, because as in share investors, we all own a little bit of the pie. That bit of the pie is worth something, and if that bit of the pie doesn't grow over the long term, well, I can tell you, I'll show you a share price that doesn't either. So, you know, quality companies with strong financial health, good return on invested capital, good return on equity, good margins, strong levels of profit growth and earnings per share growth. And then, of course, from an income perspective, Fauzia, is you want to make sure that you're not overly stretched on the dividend. So you can, your dividend payout ratio, ensure that the dividend they're paying is coming from a cash pool that they can fund, because if they're borrowing or underwriting that dividend, there could be strains on that future earning. Absolutely. Like with NAB, for example.
Definitely. We've just got a few, about 30 seconds to go. David, anything you want to add to that?
Yeah, look, all of that. I mean, I got eight key fundamentals that I look at, that I teach. If anybody's interested, I'm running a workshop at the end of this month, it's 25th, 26th, and that's exactly what I teach, and combined with the technical. So there's the fundamentals, but there's also the timing factor as well.
Absolutely.
You know, but look, ultimately you're investing in management. You know, that's who you're investing in, who's behind the company, their credibility, all of those factors, because it doesn't matter, okay, you can have a great product, but poor management will ruin a business. So, you know, all of those factors that Elio pointed out and that I endorse as well, but earnings growth, the sector you're in, and return on equity, and, you know, building a strong balance sheet and return to investors. I mean, that's the thing I look for.
Yeah, that's why we've got 9 rules too, because there's a lot more to just that quant screen. Then you've got to really delve in to find the elite companies.
Okay. When we come back, we will answer more of your market queries. We'll also have the latest economic analysis with Janu Chan from St. George. Do stay with us here on Trading Day, Your Call.